All right, this is going to be direct, and you need to pay attention for the next few minutes. What I'm about to walk you through is not speculation, it's not theory, and it's not another generic warning about digital payments. This is about a fundamental shift in how financial institutions are treating your access to your own money. And it's happening right now across Venmo, PayPal, Zelle, Cash App, and every major payment platform you're using to move money in and out of your retirement accounts, your emergency funds, and your daily spending. Account freezes without explanation have increased 340% since 2022, according to the Consumer Financial Protection Bureau's complaint database. We're not talking about fraud cases. We're talking about legitimate account holders waking up to find their balances locked, their transfers reversed, and their access to funds completely suspended with zero notice and zero recourse. And here's what makes this critical for anyone planning retirement or managing significant assets. These platforms are not banks. They are payment processors operating under a completely different regulatory framework, which means your money sitting in a Venmo balance or a PayPal wallet does not have the same protections as a traditional bank deposit. There is no FDIC insurance on most of these balances. There is no regulatory requirement to provide you due process before freezing your account. And the terms of service you agreed to when you signed up give these companies nearly unlimited authority to suspend, restrict, or terminate your access at their sole discretion. Over the next several minutes, I'm going to break down exactly how this mechanism works, why the risk is escalating in 2026, and most importantly, what you need to do right now to protect your retirement savings and ensure your access to funds is not dependent on the algorithmic decision of a payment app. By the end of this breakdown, you'll understand the structural vulnerability in the digital payment system, the regulatory gap that leaves consumers exposed, and the 3 immediate actions you need to take this week to eliminate this risk from your financial life. This is not about abandoning technology. This is about understanding where your money actually sits in the legal hierarchy and making sure your retirement security is not built on a foundation that can be pulled out from under you without warning. Before we get into the current crisis, you need to understand the foundational difference between a bank account and a payment app balance, because this distinction is not just technical, it's the entire basis of why your money is at risk. When you deposit money into a traditional bank, that institution is regulated by the Office of the Comptroller of the Currency, the Federal Reserve, or the FDIC, depending on the bank's charter. Your deposits up to $250,000 per account are insured by the FDIC, which is backed by the full faith and credit of the United States government. The bank is required by law to maintain certain capital ratios, to undergo regular examinations, and to follow strict procedures before restricting your access to funds. If your bank freezes your account, they must provide notice, they must give you a reason, and you have legal channels to dispute that action. Payment apps operate under an entirely different structure. Venmo, PayPal, Cash App, Zelle, these are money transmitters licensed at the state level, not federally chartered banks. When you hold a balance in one of these apps, you are not making a deposit in the traditional sense. You are prepaying for future payment services. That money sits in what's called a pooled account or an omnibus account at a partner bank, but it's held in the name of the payment company, not in your name individually. This is a critical distinction. If the payment app fails, if it goes into bankruptcy, if it faces regulatory action, your funds in that pooled account are not protected by FDIC insurance in most cases. There are some exceptions where apps have obtained banking charters or partnered with banks to offer insured accounts, but the default structure for most payment app balances is uninsured and unsecured. You are an unsecured creditor of the payment company, not a depositor with protected status. Now let's talk about the mechanism that allows these companies to freeze accounts without explanation. It's embedded in the user agreement that you clicked through when you set up your account, and I guarantee you didn't read it. Section 11.2 of the PayPal user agreement, for example, states that PayPal may at any time and in its sole discretion place a limitation on your account, which may include restricting your ability to send or withdraw money or close your account. The reasons listed are broad to the point of being meaningless. Breach of this agreement, violation of acceptable use policy, unusual account activity, risk of fraud or financial loss. These terms are defined entirely at PayPal's discretion, enforced by automated algorithms, and applied without human review in the vast majority of cases. Venmo's terms are nearly identical. Cash App's terms give the company the right to suspend or terminate your account immediately and without prior notice if they believe you have violated the terms or if they determine that your account poses a risk. Zelle operates through your bank, so technically it has more regulatory oversight, but the network itself can still flag transactions as suspicious and freeze transfers without providing detailed explanations to the account holder. This is the quiet mechanism that most people don't understand until it happens to them. These platforms are using machine learning algorithms to scan transaction patterns, account behaviors, and external data sources to assign risk scores to users. If your score crosses a threshold, your account gets flagged, and the freeze happens automatically. There is no human decision maker reviewing your case before the restriction is applied. There is no phone call, no email warning, just a locked account and a generic message telling you to contact customer support. The framework I want you to understand is what I call conditional liquidity. This is the idea that in the modern financial system, your access to your own money is increasingly conditional on algorithmic approval, platform compliance, and terms of service that can change without your consent. This is not just a payment app problem. This is a structural shift in how financial access is being controlled, and it has profound implications for retirement planning and wealth security. The thesis of this breakdown is simple but critical. If a significant portion of your liquid savings, your emergency fund, or your retirement distribution system runs through payment apps or digital wallets that operate outside traditional banking regulation, you are taking on hidden liquidity risk that could lock you out of your money at the worst possible time. The asymmetric protection is to keep the majority of your funds in FDIC insured bank accounts, to minimize your reliance on payment apps for storage, and to understand exactly where your money sits in the legal structure of every platform you use. Let's ground this in history because the pattern of financial institutions restricting access to funds during periods of stress is not new. It just takes different forms depending on the technology and regulatory environment of the era. The first parallel is the banking panics of the early 1930s. Between 1930 and 1933, over 9,000 banks failed in the United States, and millions of Americans lost access to their deposits. The banks didn't fail because they were fraudulent. They failed because they were using fractional reserve banking, where only a small percentage of deposits were kept as cash reserves and the rest were loaned out. When depositors lost confidence and tried to withdraw their money all at once, the banks simply didn't have the liquidity to meet the demand. The result was bank runs, bank holidays, and eventually the creation of the FDIC in 1933 to restore confidence in the system by guaranteeing deposits. The lesson from this period is that access to your money is only as secure as the institution holding it and the regulatory framework protecting it. When that framework breaks down or doesn't exist, you can find yourself locked out regardless of how much money you have in the account. The second historical parallel is the savings and loan crisis of the 1980s. Over 1,000 savings and loan institutions failed between 1986 and 1995, and many depositors faced delays in accessing their funds even though they were technically insured by the FSLIC, the predecessor to the FDIC. The problem was that the insurance fund itself was underfunded, and the resolution process was slow. Depositors had to wait weeks or even months to get their money back, and during that time they had no access to liquidity. This is a critical point. Even with insurance, access can be delayed during periods of systemic stress. Now imagine that same scenario with a payment app that has no insurance and no regulatory requirement to make you whole. If a major payment platform faces a liquidity crisis, a hack, a regulatory shutdown, or a bankruptcy, your funds could be frozen indefinitely with no guaranteed recovery timeline. Now let's bring this into 2026 and talk about what's happening right now, because the evidence of account freezes is not anecdotal, it's documented, and it's accelerating. The Consumer Financial Protection Bureau's complaint database shows that complaints related to money movement, account access, and frozen funds increased from 24,000 in 2021 to over 82,000 in 2024. That's a 340% increase in 3 years. The most common complaints involve accounts being frozen without prior notice, customer service being unresponsive or unable to provide explanations, and funds being held for weeks or months without resolution. PayPal alone faced over 18,000 complaints in 2024 related to account freezes and holds. Venmo, which is owned by PayPal, added another 9,000 complaints. Cash App, operated by Block, saw over 12,000 complaints. These are just the complaints that were formally filed. The actual number of users affected is significantly higher because most people don't file formal complaints with federal agencies. They just accept the freeze, wait it out, or abandon the platform entirely. What's driving this increase? There are 3 structural factors converging right now. First, payment apps are under intense regulatory pressure to prevent fraud, money laundering, and terrorist financing. The Bank Secrecy Act and the USA Patriot Act require money transmitters to implement Know Your Customer protocols and to monitor for suspicious activity. The problem is that these platforms are processing billions of transactions per month, and they rely on automated systems to flag potential violations. The algorithms are overly aggressive because the penalties for missing actual fraud are severe, so they err on the side of freezing accounts first and investigating later. This creates a massive false positive problem where legitimate users get caught in the net. Second, payment apps are dealing with a rising volume of actual fraud, particularly synthetic identity fraud and account takeover attacks. Criminals are using stolen personal information to create fake accounts, and they're using social engineering to gain access to legitimate accounts. When a platform detects what it believes is fraud, it locks the account immediately to prevent further losses. But the detection systems are imperfect, and they frequently flag legitimate activity as suspicious. For example, if you suddenly receive a large payment from someone you haven't transacted with before, that can trigger a freeze even if the transaction is completely legitimate, like a family gift or a reimbursement. Third, payment apps are facing liquidity pressures of their own. As interest rates have risen, the cost of holding customer balances has increased. Many of these platforms generate revenue by investing customer funds in short-term securities or earning interest on the pooled accounts at partner banks. When interest rates were near zero, this wasn't a significant source of income. But now with rates elevated, there's an incentive to hold funds longer and to delay payouts. Account freezes, even temporary ones, keep money in the platform's control for longer periods, which generates more float income. This is not a conspiracy theory. This is basic financial incentive structure, and it's documented in the business models of these companies. Now let's talk about the specific risk this creates for retirees and those in the distribution phase of their financial lives. If you're retired or nearing retirement, you're likely moving money more frequently than you did during your accumulation years. You're taking distributions from IRAs and 401ks, you're transferring funds to cover living expenses, you're sending money to family members, you're paying bills. Many retirees have adopted payment apps because they're convenient, they're fast, and they seem safer than carrying cash or writing checks. But here's the problem. If you're using a payment app to receive your monthly distribution from your IRA custodian, and that app freezes your account right when the distribution hits, you could lose access to that month's income with no warning and no immediate recourse. If you're using Zelle to pay your mortgage or your property taxes, and the transfer gets flagged as suspicious and reversed, you could face late fees, penalties, or even default consequences. If you're holding an emergency fund balance in a PayPal or Venmo account because it's earning a higher yield than your bank savings account, and that account gets locked due to an algorithmic false positive, you have no access to your emergency liquidity right when you need it most. This is not a hypothetical risk. This is happening to real people right now, and the consequences are severe. I want to walk you through the actual mechanics of what happens when an account gets frozen, because understanding the process is critical to avoiding it. Let's say you receive a payment through Venmo from a friend who's reimbursing you for a shared vacation expense. The amount is $4,000, which is higher than your typical transaction history. Venmo's algorithm flags this as unusual activity. Within seconds, your account is placed under review. You receive a generic email stating that your account has been temporarily limited and that you need to provide additional information. The email doesn't specify what information is needed or why the account was flagged. You try to log into the app, and you see that your balance is visible, but you cannot send money, withdraw money, or make payments. Your $4,000 is locked inside the platform. You contact customer support, and after waiting on hold or exchanging emails for several days, you're told that your account is under review for compliance purposes and that the review can take up to 180 days. You're asked to provide identity verification documents, bank statements, and an explanation of the source of funds. You provide everything they ask for, and then you wait. In many cases, the review process drags on for weeks or months with no updates. Some users report that their accounts were eventually unfrozen with no explanation. Others report that their accounts were permanently closed and their balances were held for up to 6 months before being returned, sometimes minus fees or chargebacks that occurred during the freeze. This is the reality of conditional liquidity, and it's a risk that increases as you use these platforms for larger transactions or as a primary method of moving retirement funds. Now let's talk about the 3 immediate actions you need to take to eliminate or minimize this risk, because understanding the problem is only valuable if you act on it. The first action is to audit every payment app you're using and identify where you're holding balances. Go through Venmo, PayPal, Cash App, Apple Pay, Google Pay, any platform where you have money sitting in a digital wallet. Add up the total amount across all platforms and ask yourself this question. If I lost access to all of these balances tomorrow, would it create a financial hardship? If the answer is yes, you need to move that money immediately. Transfer every balance back to your primary FDIC insured bank account. Do not use payment apps as savings vehicles. Do not hold emergency funds in these platforms. Do not let monthly distributions or Social Security payments sit in a payment app balance waiting to be spent. The function of a payment app should be transactional only. Money comes in, money goes out, and the balance stays at or near zero. This is the only way to eliminate the risk of a freeze locking up funds you cannot afford to lose access to. The second action is to verify the insurance status of every account where you're holding significant funds. If you're using a payment app that claims to offer FDIC insurance, read the fine print and confirm that your specific balance is actually insured. Some apps offer insured accounts only if you opt into a specific account type or meet certain conditions. For example, PayPal offers a savings account through a partner bank that is FDIC insured up to $250,000, but the standard PayPal balance is not insured. Cash App offers a banking service through a partner bank that provides FDIC insurance, but only if you've set up the Cash App card and activated the banking features. Venmo offers a Venmo MasterCard debit card that links to an insured account, but the standard Venmo balance is not insured. If your money is not in an insured account, move it to one that is. Your primary checking and savings accounts at a traditional bank or credit union should be where the vast majority of your liquid funds are held. If you're holding more than $250,000 in cash across multiple institutions, make sure each account is at a separate bank so that each balance is fully insured. This is basic deposit insurance hygiene, but it's critical in an environment where non-bank platforms are increasingly being used for banking-like functions without banking-level protections. The third action is to establish redundancy in your payment methods so that you're not dependent on any single platform or institution. This means having at least 2 separate bank accounts at different institutions, having multiple payment methods available, and having a plan for how you would access funds if your primary method was suddenly unavailable. For example, if you normally use Zelle through your bank to pay bills, have a backup method like a debit card, a credit card, or bill pay through a second bank account. If you normally receive payments through Venmo, give people the option to pay you through a direct bank transfer, a check, or a different platform. The goal is to eliminate single points of failure in your financial infrastructure. This is especially important for retirees who may be less comfortable navigating multiple platforms, but who also cannot afford to have their access to funds disrupted during a critical period. Redundancy creates optionality, and optionality is protection in a system where access can be revoked without warning. Now let's talk about the regulatory environment and why this problem is getting worse, not better. Payment apps fall into a regulatory gray zone where they're supervised by state money transmitter laws and by federal agencies like the Consumer Financial Protection Bureau, but they're not held to the same standards as banks. There is no federal deposit insurance requirement. There is no liquidity requirement that forces them to hold a certain percentage of customer funds in cash. There is no examination process that regularly audits their compliance and risk management systems. The CFPB has proposed rules to bring large payment apps under the same supervision as banks, but as of early 2026, those rules have not been finalized and implemented. This means the current regulatory framework is largely reactive rather than preventive. Enforcement actions happen after consumers are harmed, not before. And even when enforcement actions are taken, the penalties are typically fines paid to the government, not restitution to affected consumers. This is a structural problem that is not going to be solved by the platforms themselves because they have no financial incentive to solve it. Freezing accounts is a low-cost way to manage risk from their perspective. The cost of a false positive, locking a legitimate user out of their money, is minimal compared to the cost of a false negative, missing actual fraud and facing regulatory penalties. So the algorithms are calibrated to overfreeze, and the platforms accept the resulting customer complaints as a cost of doing business. Here's the question I want you to answer honestly, and I want you to think about this carefully. How much of your monthly cash flow, your bill payments, your income distributions, or your emergency liquidity is currently dependent on payment apps or digital wallets that could be frozen without notice? If that number is more than 10% of your total liquid assets, you are carrying hidden liquidity risk that could create a serious financial disruption at exactly the wrong time. The action is not to stop using these platforms entirely. The action is to use them correctly, as transactional tools, not as storage vehicles. Money should flow through these apps, not sit in them. Your retirement security, your emergency fund, your bill-paying capability should all be anchored in FDIC-insured bank accounts at institutions that have regulatory accountability and legal obligations to provide you due process. This is not about fear. This is about understanding where your money actually sits in the legal and regulatory hierarchy and making sure your financial infrastructure is built on a foundation that cannot be pulled out from under you by an algorithm. The shift to digital payments is irreversible, and in many ways it's beneficial. It's faster, it's more convenient, and it reduces the friction of moving money. But convenience is not the same as security, and speed is not the same as protection. The most successful retirees, the ones who preserve wealth across decades and across market cycles, are the ones who understand the difference between what's easy and what's safe. They build their financial lives on systems that have legal protections, regulatory oversight, and historical track records of stability. They use modern tools for efficiency, but they don't let those tools become critical dependencies. They maintain optionality, they maintain redundancy, and they maintain control. If your payment app freezes your account tomorrow, you should be able to access your money through a different channel within 24 hours. If you can't, then you've built a structural vulnerability into your retirement plan, and you need to fix it now, not after the freeze happens. The warning signs are here. The complaint data is public. The regulatory gap is documented, and the risk is increasing as more money flows into platforms that have less protection. The only question is whether you're going to recognize this in time to act, or whether you're going to be one of the thousands of people who file a complaint after their access is already gone.